those with short-term cash needs. The core assumption of passive investing is a long time horizon, the ability to tolerate volatility. For example, the S&P 500 has historically produced positive returns over the long term. However, in 1 to 3 year periods, it has experienced significant declines. If you need the money within 1 to 2 years, have mandatory goals such as buying a house, a car, or paying off debt, passive investing may be risky, because without time, compounding cannot work. Those who cannot tolerate high volatility. Behavioral finance pioneer Daniel Kahneman demonstrated through loss aversion that people are more affected by losses than by gains. In passive investing, 20 to 30% declines are possible. Temporary losses create psychological pressure. If an investor panic sells during downturns, constantly checks the portfolio, loses sleep over fluctuations, then passive investing may be theoretically suitable, but behaviorally unsuitable. Those who constantly seek action. Passive investing is boring, involves little trading, requires long waiting periods. Some people enjoy daily analysis, like reading charts, want to make active decisions. For these individuals, passive investing may not be psychologically satisfying. For example, even though Warren Buffett recommends passive investing for most people, he personally performs active company analysis. But that requires discipline, knowledge, and patience. Investors with a strong need for action often build a passive system and later break it. Undisciplined savers. The fuel of passive investing is regular saving, systematic investing, staying in the market long term. If someone cannot save consistently, has no income, expense control, lacks continuity, the mathematical advantage of passive investing weakens. Those with excessive overconfidence. Research by Brad Barber and Terence O'Dean shows overconfident investors, those who believe they can beat the market, frequent traders, earn lower returns on average. Passive investing requires accepting this mindset. I may not beat the market, I will grow with it. Not everyone is comfortable with that acceptance. Those with very low patience. The real power of passive investing is time. But time feels boring in the early years, does not create quick wealth. Data from Vanguard show that staying invested long-term increases returns. However, for someone expecting big results within 2 to 3 years, passive investing may feel disappointing. Those trying to be passive without a system. Passive investing requires goal setting, risk allocation, cost control, rebalancing. It is not simply buy a fund and forget it. Without a strategy, passive investing becomes unconscious waiting. A realistic distinction. Passive investing is suitable for someone who is long-term oriented, patient, resilient during downturns, disciplined, a consistent saver. Passive investing is not suitable for someone who is short-term focused, panic-prone during declines, constantly seeking action, frequently changing strategies, looking for quick wealth. The most important truth. In most cases where passive investing fails, the problem is not the system. It is the investor's behavior. Mathematically, it may be strong, but if it is not psychologically suitable, it is not sustainable. Conclusion. Passive investing is not for everyone, but for the right personality type, it is extremely effective. The real question is, do I want to grow with time or with excitement? If your answer is time, passive investing is a powerful tool. If your answer is excitement, passive investing may leave you halfway.